What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online, as usual. We're jumping into the exciting world of mortgage underwriting today. I started talking about this a little bit yesterday when we looked at this property in Pigeon Forge. It's a listing on Lofty that is set up somewhat like a mortgage. There's a set repayment amount, there's a set yield, a time that the payment is due, and it can be paid off earlier. And it's very similar to a couple different deals that they've put on their site. Some of them they've sort of referred to as like HELOC style because it's an owner occupant trying to take out some of their equity. But in general, I understand why the structure looks a lot like a mortgage. But I wanted to dig a little bit deeper into if we were going to do deals where we're acting as a lender, or we wanted it to look more like we're acting as a lender. What should our underwriting look like, and what sort of protections should we be looking for that we're not getting? I know this style of deal has been really popular on Lofty, and I think that to a certain extent it's because people don't really have experience underwriting mortgages and looking at really trying to see what their risks are and understanding how mortgage risk is significantly different from investing in the equity of a property, and it's why your mortgage rate is typically, and I say typically because right now in our market it's not necessarily the case, but in general mortgage rates are lower than cap rates and lower than the yield that you'd expect to get on the property. Now that's been turned upside down in a lot of markets today. Um, but in general, as a lender, you get a lower yield, but it's because you have a more secure position. And that just doesn't seem to be the case with what they're doing. And so I wanted to jump into one, just talk about mortgage underwriting in general. I think this will probably be useful for a lot of people who, all of our investments or a lot of the investments on any of the sites we're looking at, whether it's Lofty, Mogul, any of the places where there's a mortgage involved. I think this becomes important. It's also the case, like if you're investing in mortgage in ground floor, understanding what ground floor was looking at and some of the stuff they report, and they don't really share a lot of the data. Um, but from having tried to help clients borrow from them in the past, I understand that they're definitely doing some of this underwriting. They just only share certain metrics, but not really everything, which is unfortunate. But I think that it's one of the reasons why I'm looking at the broad diversification on that platform, excuse me, versus, really digging into each individual loan. But so this is the property I was talking about yesterday, but, this is, there's several of these on the platform. This is another one where it's like an owner occupied, um, property, and this one's really set up to look like a loan where it looks like the amount that's paid is based on the federal funds rate, so it looks kind of like an adjustable rate mortgage, although they pay uh, a little bit of appreciation. Um, so there's I don't know, it's sort of weird. It almost looks like there used to be this type of loan product that was like where there was a lender participation. I can't think of exactly what it was called, but they participated in the upside, in the appreciation, not just in the loan itself. But so it kind of looks like that. But a lot of them just look like straight debt. Like, okay, we're going to pay it back at this amount. And so anyway, if I were to want to invest in these, I want to look at it as if it's debt, right? I want to underwrite it as if it's debt. And so, if you were a classically trained mortgage underwriter, you're always going to talk about the four C's, right? And you've probably, if you've applied for loans or talked to many loan officers, you've heard this at some point. At least I think you have. It's both in commercial lending, and even if you go to the Fannie Mae, Freddie Mac sites, they have this. And I just pulled up a random bank's one that I liked the way they presented it. But so four C's: capacity, collateral, capital, character. And character really has been changed to credit by most people today, especially on the residential side when they say this. But so I'm going to go into each of these things and so what I think I'm always thinking about how can we so push different platforms to provide us with better information, and also too, how can what can we just ask of co-owners in order to whoever's bringing this to the platform. And from now on, for these deals, I'm going to refer to the co-owner as the borrower. I understand it's not a loan and they're not a borrower, but I'm just going to do that for simplicity. So we can go jump into the Discord and ask the borrower to answer some questions about these things. But ideally, we'd ask Lofty to include all of this information or a good portion of it in the listings when they do this style of listing. And so if we talk about capacity, it's all about the ability to repay, right? So typically you're going to look at the income of the borrower, you're going to look at their debts, and we're going to calculate a debt to income ratio. And what that standard is, we can disagree on like what percent that debt to income should be because different lenders have different standards, and so maybe it would be too low for me or too high for me, but maybe somebody else would want to invest in it if it were a certain percent. But at the moment, we're not even presented with the information to make that sort of decision. Um, and just as an aside, some people say, capacity isn't always used because like it's not there with hard money loans and it's not there with debt service coverage ratio loans. I don't really believe that because you're just looking for something different for the capacity to repay. So for debt service coverage ratio, it's really does the property itself throw off enough cash to provide the capacity to repay? And for hard money loans, it was always is it kind of mixed with collateral. It was just does is the property itself sufficient to repay the loan if we if we liquidated it, right? And so that's actually as hard money has evolved over the last bunch of years. They've started to look at capacity a little bit more than they ever used to sometimes, and it's because they've increased their debt service coverage ratios a lot. It used to be, hard money loan, you'd get 55, 65%. You'd never get these really high percents that you see in the market today. But anyway, sorry, that's an aside. As far as collateral goes, this is the one that I think Lofty does a good job of providing. We get a description of the property, we get an appraisal. Um, so they're actually giving us some info there. Where they're falling down is, one of the things when I look at collateral is this is where I start to think about my loan to value ratio, right? And um, they're just allowing you to sell 90% of the collateral value, and actually they're allowing you to sell 94.5% of the collateral value because they let you increase the value, from the appraisal. They let you say the value is an extra 5% higher, right? And so even though we have good information about the collateral, we don't have uh, this type of the way it's set up. We're not limiting the amount that they're allowed to borrow or sell against to some reasonable loan to value ratio. And then you have capital. This is where you're just looking at does the borrower have other funds available? They have other investments, they have a retirement account, anything else that they could liquidate in the event that, when we looked at their income that they're going to use to repay it, something happens to that income. We want to see, okay, they have another way to repay or to get them through some gaps. And that's why we look at capital, right? Do they have some liquidity? What other resources do they have to pull from? Um, and then, when I talked about collateral too, and I mentioned this in yesterday's video, I think, is one of the things, if you don't feel like you have sufficient collateral in the property itself, we also often look at, what else could you pledge as collateral, right? Could you put a CD in my bank, right? If I'm a bank lender, this is one of the things they often do. Or if you have securities that you have invested with us, can we use those as additional collateral? But that's one of the ways that you see lenders ramp up their loan to value ratio because they're getting some additional collateral. None of that's happening here. We don't know anything about any other property that they might be able to give us a lien on. Um, and then character, this has basically been replaced by credit. And you might say, well, hey, Lofty gave us a credit score. Um, I think honestly, the credit score, that's really just the tip of the iceberg, right? It's not Having that score, first of all, each credit reporting agency, uh, their scores that they report, they typically have more than one credit score, right? It's not as if they only have one way to do it. If they have it, that's used for different things, they'll actually report a different number, and so it's not completely clear what type of credit score this is that we're getting from Experian. But then the other thing is I want a credit report, right? When I'm looking at a borrower, I want to see, okay, they have great credit. Have they had any late payments? Did they have a foreclosure 6 years ago and they've just rebuilt their credit since then? I mean, it's actually amazing how quickly you can come from a bankruptcy or come back from a bankruptcy or foreclosure as far as your credit's concerned, right? And so some of those things won't fall off for 7 years or certain periods of time. And being able to see those, uh, the score just doesn't tell you the whole story. Did they have an eviction? The sorts of things. Um, I want to know a little bit more. And then also too, on the commercial side and with investment deals, this is where they're often also asking about the borrower themselves, their reputation in the marketplace, their experience doing other similar deals, those sorts of things. And so, they tell us a little bit about the borrowers, but I mean, very, very little relative to I'm going to lend this person money. I'd like to know a lot more about it. And so, after today, which after I had put out this video, there was a lot of discussion in the Discord. And this particular co-owner jumped in and talked a little bit about some of this stuff. And I think that's, we do have the ability to ask these questions, but it's sort of awkward to just be like, so what's your net worth? What's your income? How are you planning to repay this? Like if we just had a standard, if we had a personal financial statement that they had to fill out in order to list this style of deal on Lofty. I mean, Lofty is a marketplace, right? They can require any sort of reporting that they want in order to put a listing up. If you're going to have this structure of a deal that looks like debt, why not require some of the underwriting stuff that you'd want to see? Now, I think some borrowers are going to be uncomfortable having basically their loan application published on Lofty, and I think this becomes a problem. It becomes a problem in general with some of these sites where like there's certain things that some people might want to keep to themselves. I mean, this happened on Mogul, for example, where they don't want to share the appraisals before the deal closes because they don't want everybody to see that appraisal. But it also makes it difficult for me to want to invest, right? Like those sorts of things happen. And here, right, like we want to know this information, but they might not want to make it public. And so it's tough to, it's a balancing act for sure, and obviously they have to redact a lot of stuff. But at a bare minimum, what they could do is Lofty could compile the information and then just provide certain metrics like this is the debt to income ratio, this is the net worth, range or something. There's got to be some balance that you could do where we could know something about these borrowers that would give us some confidence in their ability to repay. And I'm talking about these specific deals that look more like debt. But I think also too, anytime that we have a co-owner that's like guaranteeing a rent credit or where there's some, where we're really relying on that co-owner to make some sort of payment, it would be great to have some information about them. Before I forget, please like and subscribe. Uh, in the description to this video, there is a link to a Discord channel that I've set up to talk about fractional real estate investing in general. There's about 80 of us that are there at the moment. It just keeps growing. Talk about all the different sites I'm currently invested on and some that I'm not. I also, in the description of this video, have links to all the sites I currently invest on. Do your own due diligence on those sites. Don't just invest on there because I do. And with those, same thing with the properties. Don't just invest on in those properties because I do, or not do it because I won't, right? Like just because I'm saying I'm not going to buy into any of these deals without this information, maybe your risk profile is different than mine, right? Maybe you have a different reason for wanting to do it. And I think that's something that you want to figure out for yourself. And just trying to share my knowledge and experience in the way I look at these things. And really, I'd love it if we kind of got together and sort of pushed for some of this reporting to be a little bit more standard, right? And so those are the, as far as from underwriting perspective, from looking at these deals, that I'd like to see either Lofty provide that info or all of us just be a lot more proactive in asking those questions in the Discord. I think that's a far inferior way to go about it, right? I'd much rather see Lofty do a little bit more as far as require, their requirements to put this type of deal on their platform. But then the other thing too that I talked about is how much that, aside from, okay, we don't really have the information to underwrite this as a loan. Um, I want to talk a little bit about some of the protections that we're not really getting as if it were a loan. And so let me jump into it. Let's see what I've got here. Oh, first of all, and I touched on this yesterday, but the fact that we don't have a lien, right? That we have ownership in the DAO owns the property instead of having a lien on the property. Ooh. A lot of people thought, and I had this discussion with a few people, that you have more protection by us just owning it. In certain sense, that's true because, if you're a lien holder, your recourse is to take over the property and own it. But one of the things that I think a lot of people miss in that process is if there are junior liens, if there's money owed behind us as a priority lien holder, um, those get wiped out, so we don't owe them. If in this situation where the DAO owns the property directly, yeah, okay, if we claw back the equity, but some additional lien was put on the property in the meantime, uh, we're going to get paid out after that in the case of a sale. And it's unlikely that you'd have an additional lien, but like if there was somebody had gotten hurt on the property and there was a lawsuit and then that created some liability, or a contractor did some work on the property and filed a mechanics lien. In both of those instances, we'd have some issue where if we did have to take it back and sell the property, those liens aren't going away without us paying for it, right? Where if we are have priority over those liens, and there's the system of priority changes from one state to the next, and how so it's not exactly clear where we'd stand. Typically, taxes are going to have a lien superior to ours no matter what. And sometimes there's other statutory ones like HOAs and whatnot. But in general, it's first in time, first in right, right? Like if we got our lien first, any of the stuff that happens after us, if we foreclose, that stuff gets wiped out. And so there's a lot of instances, where we don't control the property, right? If it's either the owner occupant type borrower or it's just the vacant land type borrower who's just land banking it. In both of those instances, I don't want to have any sort of other liability. I'd much rather be a lien holder. Maybe your opinion on that is different, and I think that that's something that there's some room for disagreement there. But if we're trying to look at it like it's debt, why not get a lien, right? Why are we I'm not sure. I don't know if Lofty just doesn't feel like they can do that or not. And then the other thing is because it's not debt, we can't really report it the same way. I think you can, the missed lease payments. I'm fairly certain we can report those to their credit. But if we do this where we claw back the equity, that's not a foreclosure, so we can't put a foreclosure on their credit report. And I think that that's one of the strongest leverage points that we have as a borrower or as a lender is being able to foreclose on a borrower. If they're a real estate developer, having a foreclosure on their report is like one of the last things that they ever want to see. It's like my third time trying to do this because my laptop keeps freezing, and so I'm getting a little hoarse. Sorry about that. Um, But so yeah, not having that protection I think is a problem. But then I was just looking through the documents and just thinking about some of the things that I normally have when I'm acting as a lender because I do make private mortgages. Um, and some of the stuff that I didn't see, I looked through the lease for the one that I was talking about, and then the addendum to the operating agreement. Then I also looked at one of the other ones where it's an owner occupant, and they're using that same really simple lease. And so it's just missing a lot of the stuff that I would want in a loan agreement. And so, and even in a regular lease sometimes. So one, late fees, right? If they don't make their payment, the way it's set up now is, okay, well, if they don't make their payment for 90 days, then we can claw it back. Well, is there any repercussion for them to just be consistently 89 days late? I'm not sure. I don't see anything that about that. A default rate of interest, I don't see that, right? So usually, if there has been a default in the note and mortgage, we get to charge a higher rate of interest from that point forward or until the default is cleared. And sometimes that's a significantly higher rate. Sometimes we'll have a 6% mortgage and a 12% default rate. And so that helps keep borrowers in line, keeping them from these minor defaults, right? Because they know it's going to cost them a significant amount of money. We don't have any sort of acceleration clause. And so what that usually is if a borrower misses a payment, they default in some way, instead of just being able to collect that payment, we get to say, okay, the whole amount of the loan is due. We don't have anything like that now. Because we can still just claw back their equity, it's sort of giving you that same ability. Like, we're just taking all of your ownership, or really we're just taking back the remaining 60% of the seller's ownership. The seller will put up 60% of their ownership in the property as collateral. And this whole section, I still have not really figured out what they're trying to talk about here. If it's like the part that they're holding, they're putting up, the part that they keep, so we can take 60% of that 10% that they have left. I mean, I still don't fully grasp what this is doing. But regardless, it's not a full acceleration clause. Um, we're asking them to pay the taxes and insurance, but if they don't pay it, what do we get to do? That's not even, these clawbacks just say if they don't pay the monthly payment, or they don't do the buyback in time. It doesn't say anything about, okay, what if they don't make these payments, right? And okay, so this is a lease, so maybe they're in default under the lease, but what do we get to do? We don't get to evict them here because there's not, they're not actually occupying the land. So are we going to try to collect this? There's just not, it's not very useful, right? So I'd want to have, if I'm a lender, I usually get to force place insurance, right? I get to, okay, they didn't pay the insurance. I get to go put insurance on it. It's usually an expensive policy, and I get to just tack that onto the loan. The borrower has to pay me that amount of money. Um, Same thing for taxes. If they're not paying the taxes, I get to go pay the taxes and add that to the loan. Sometimes I get to charge an additional fee for doing these things too. Uh, there's nothing in here about that, right? So we're not getting some of the protections, and this is not an exhaustive list at all. Like, I'm sure there's 50 more things that you could come up with if you spend some time that are in typical loan documents that are protecting the lender that we're not seeing here. And speaking of the taxes and insurance, a lot of times the lender gets the right to escrow the taxes and insurance, right? So we get the right to hold the money and make those payments. Now, as a private lender myself, it's not something I've ever opted to do. I'd much rather just confirm that those things are being paid, um, just because it's a cumbersome process. There's a lot of laws about it that change from one state to the next, and most of the time, the deals that I'm doing, the amount of money at stake for those two things are just not really worth it. But then one of the things too, but it's something I think that should at least be thought about. I'd actually really just like to have, the rights that we have outlined a little bit more about those two things. And then in addition to that, attorney's fees. Like, if I'm foreclosing on a property, usually my loan documents say I get to, my collections costs and attorney's fees, I get to tack that onto the loan. That's not standard if I'm just, if it doesn't say that in this lease, and I'm, trying to collect based on the lease, I'm not necessarily going to get that. It's not the standard that you just get paid your attorney's fees, when you're suing to collect certain things. And so, I'd want that. when typically when I'm acting as a lender, I have that in my documents. I don't understand, that's what I'm saying when I'm saying like these are just really thin documents. Like if I'm trying to create this relationship, I want to have some of these standard protections. And so, or what in my mind are standard, right? I mean, standard definitely changes from one market to the next, one lender to the next. Um, and like I said, I mean, these are just, it's certainly not everything, but when I'm saying that I don't think we're getting a good risk adjusted return, I'm looking, if I'm getting paid 10%, and that's close, it's somewhat in line with the ground floor mortgages that you can invest on, which is what we should always be doing, right? When we're thinking about investments, we always have to compare it to like, okay, what's my other option here? What's a similar risk level, and what am I getting paid for? And so if you look at the lack of protections on here versus like what you would typically get, as a lender in other instances, it, we aren't getting, we're not covered in the same way, right? We're not provided with the information that we need to be able to underwrite that borrower. Lofty's not doing anything about, one of the things that I think people think that Lofty thinks about some of this stuff, and they're not, right? They're not at all thinking about this borrower's ability to repay us, right? They got the appraisal, they put, they're not, this is not, their wheelhouse, right? And so if we don't get this information and we're not thinking about it, nobody is. And so we have no real way of understanding what the risk level is of this particular mortgage versus the next one, other than just being able to look at the value of the collateral, right? Like really all we're getting is the collateral and a credit score number, and then some very thin documents that are not giving us, that are not covering a whole bunch of different situations that could come up. Um, And one of the things I'm sure that Lofty would say in response to this is, well, you as a DAO, you can vote to change some of these things. Well, we don't get to just vote to change a lease agreement that's signed with the borrower, right? And again, I'm just saying borrower. I know they're not really borrowing. They're in this instance, they're the tenant here. Um, Obviously we can't just change this stuff. And so the way they bring it to the platform is, we're in a take it or leave it situation. And so hopefully, as a group, we can give them some feedback around some of these things that we'd like to see different. If they're trying to give us a product that's that, okay, I can invest in this, or I can invest in a mortgage on ground floor, or I can invest, in a private mortgage that I'm lending out myself, and I'm trying to make an apples to apples comparison, they could give us, right now, they could give us a lot of things that would make it look much more like it's a true comparison, where right now we're just not getting, we're not getting most of the info that we need to look at as far as the four C's are concerned. And then as far as the documents themselves go, I mean, we're just missing a lot of the protections that I'd like to have. And then on top of that, again, I mean, I don't understand, if we're trying to make it look like a loan, why not just get a lien? In the instances where it might be a second mortgage, and I keep clicking on this one, I don't necessarily know that that's this one, but some of them, there is already an underlying mortgage and we're acting as a second. Yeah, maybe that's not the case with this one. Um, my computer keeps crashing, so I'm not going to try to open up one to find it. But in those instances, maybe that would be a default under the underlying mortgage to have a second mortgage. Sometimes that's the case. But if it is, it's also, quit claiming it to the DAO is probably a similar default, right? That, I mean, you're triggering the due on sale that in both instances, it would be, the alienation clause or something like that. Um, in any case, that's, I think there's a lot of work to make their HELOC style deals, is what they've called them a few times, or like debt style deals, operate actually enough like debt for me to want to take, um, a debt level return, right? I mean, like a 10% rental yield with no real upside. And I mean, some of these, like this one, does have some appreciation built in, but it's barely covering, the fees that Lofty charges, right? So I mean, like when we did the math on this one, we're really only getting about a 10% return. If it gets paid off early, it'll be a little bit higher. But for the most part, that's all we're getting. Um, and again, I mean, that's I'm getting a higher rate or return on that on the ground floor deals. And then so one of the things, some of the investors that invest on ground floor are like, oh well, yeah, but I don't actually get that return because of how many defaults I have. Well, if you're comparing that to these, I'd expect at least the same level of defaults here, right? And maybe higher. I mean, I think that the default rate could be significantly higher because nobody's actually looking at these borrowers on the front end. We're not looking at the four C's. We have no real sense of can they can they make those payments, right? And so I think that if you're like, well, I've had a lot of defaults on ground floor, I'd rather invest in these ones. My guess is you'll end up being pretty disappointed. I don't know that for sure. Obviously, all of these platforms are relatively new and it's yet to be seen. And it is why, as a reminder, I am experimenting on all of these, right? I don't have a ton of money. I'm not putting some huge chunk of my net worth on any of them yet. Um, because it's a budding industry. There is a lot of work to be done to make these products something that I think will be good investments for us. Um, and like I do make a lot of money. I'm making not a lot of money because I don't have using a lot, but high returns on Lofty. But so far, all of my great returns, or almost all of them, have come from somebody else losing money, right? Because I'm getting it by buying discounted tokens. That's what's giving me the high returns, which means somebody else lost on that. I have a couple of deals on here that have given me decent returns um, that I did pay par for or more even. But I think most of those, well, one, they're fragile yields. Like we'll see what happens going forward. So anyway, that's another weird aside. Sorry about that. Really, just to wrap it up, I'd like to see us one push Lofty to give us a little bit more of this, a little bit more of the four C's, right? Whenever they have a deal that is this debt style deal, or any time that we're counting on a co-owner to make like a rent credit payment, or anytime we're counting on the co-owner to make a payment. I mean, I'd really even like to see it if they're responsible for a really high LTV mortgage. I'd like to see like how are they actually paying that. There's a few deals on the site where I don't really understand how they're doing it. And I mean, I think if we look at all of the Yom mess, it's a lot of people now are speculating that all happened because they weren't able to make the payments in the background. And so, um, kept having to keep bringing properties to the platform to sell equity to be able to cover cash flow, right? So like understanding this information anytime that we're counting on the co-owner to make payments of something for us, I mean, it would even be better. And then second, if Lofty's not willing to go ahead and make that one of their requirements, I think we can start pushing co-owners quite a bit more in the Discord to give us this type of info. Um, if we're going to do that, I think we need to be a little bit tactful about it, right? You can't just be like, "Hey, what's your net worth? Tell me all your debt." Like I mean, it's tough, right? Like I think the way a lot of people jumped in the Discord of this deal today, not everybody came across as completely respectful. Um, it wasn't terrible. We definitely have seen worse ones, but I think people are real nervous about getting scammed again or taking people's word for things. Um, and so I don't know, maybe as a group we develop some like specific question, that we ask, okay, this type of deal pops up. Lofty's not willing to, look for this info. Maybe we, just make it a practice to have certain questions that we ask every time when we do it as a group. And I don't know. I mean, I think that there's some benefit of us, exercising some cooperation in these instances, just in general, until we get a better, um, until the ecosystem's a little bit more fleshed out and we have more of the protections that we need, and there's a little bit more standardization as far as like the info that we're provided. But anyway, I think that I've gone on about that long enough for today. Um, what else as a lender would you want to know, or what other protections would you like? I know this list is not exhaustive. I spent, excuse me, maybe 5 minutes thinking about this list of things that the documents didn't have. It got long enough that I thought, okay, I think it's worth throwing that into a video. But what other protections do have you seen lenders get that you'd like to have here? If you see advantages to this model that I'm missing, I'd really love to know about those. Um, and then if you've been investing in these deals, right, in these where it's the set repayment, set yield, set repayment amount. Um, did any of this change your mind? Are you going to look for more info than you've gotten, or have you actually been asking these questions, either through DMs or directly on any of the deals? I'm curious about any of that. So please, feel free to jump in the Discord or, just put some, jump in the comments to this video. In any case, please tickle the like button. There's some bell I'm supposed to tell you about. I don't ever do the bell on mine, so I guess I shouldn't ask you to do the bell. But apparently, there's a bell. Um, and yeah, until next time, I'm going to keep making mistakes so that you don't have to.